Okay, today we are going to be looking at funding level triggers functionality through PFaroe's ALM module. I think it's fair to say that triggers-based strategies don't have a great reputation for working well with ALM functionality. So I want to look at why that is and what you can do through PFaro to get a good result on this basis. So I've set up a relatively straightforward scheme here. It's a scheme that's 80% funded on a gilts basis, and this particular scheme is invested 100% in equities. Now, as we can see from the bottom, I've focused on the 50th percentile here. The current position is 81% funding level, and with 100% investment in equities, the central position is that the scheme will be fully funded within 10 years, which sounds like great news. But as we can see from the stochastic graph, there's a lot of risk involved in this. So in theory, in 10 years, the scheme could be between 25% funded and 300% funded. So what we want to look at here in this example is whether we can use funding level triggers to take some of this risk away should investment returns be better than expected. So what I want to do first now is to show you where the funding level triggers functionality is, and then we can have a look at how we can apply it to this particular case. So if I go to the right hand side, we can see that under the strategy type, there is an option for funding level triggers. So I'm going to click on that, and then we can move to funding level triggers parameters and click on set trigger. And then we can see that a box opens that allows us to set different funding level triggers. Now what this area allows you to do is on the left hand side to define the funding levels which you wish to have changes at particular levels. So for instance, we're on about 80% funding now, so let's start there. And then we can move to different percentages that we would like to change asset allocation on. So let's say, for instance, that for every 2% increasing funding level, we'd like to move 10% of our equity holdings to index-linked gilts. So in which case we first need to change the funding levels to 82, 84, 86, etc. until we get to 100%. And then on the right hand side here, what we can do is choose from some saved scenarios that allow different investment strategies. So for example, if the funding level's under 80%, then we're going to say let's maintain the strategy is at the moment, and you can see that I've already saved some investment strategies here. This one called E100 ILG0 means equities 100%, index linked gilts 0%. So I'll apply that one there. Now, if the funding level increases above 80% but below 82%, I would then like the investment strategy to move to 90% equities, 10% index-linked gilts, which if we scroll down here, I've saved one that does exactly that. And then if we wish it to go between 82 and 84%, we can have an investment strategy that's equity 80%, index-linked gilts 20%. Now, don't worry, I'm not going to go all the way through this. I've done a Blue Peter approach and saved all of this before. So I'm going to open a scenario that I've called Triggers 1. And you can see that I've done this all before. And this applies all the way up to 98 to 100%, which is where index-linked gilts are 90%, equities are 10%. And then if the scheme becomes 100% funded, you're 100% index-linked gilts. So let's have a look what happens when we then run that investment strategy. And you can see we get a very different looking graph here. What I'd like to do now is compare this to where we were before. So I'm going to click back to our 100% equities scenario, and I'm going to tag that example. I'm focusing on the 5th to the 95th, so I'm going to just get rid of the extreme values there. And you can see that if I then compare the 100% equities approach to the trigger-based strategy, well, to be quite frank, it doesn't look that good. You can see that we've lost a significant part of the upside whilst we've retained all of the downside, which, if you recall at the beginning of this video, was a key issue that people have with trigger-based strategies and ALM. One benefit that you can see is that if we look at the central position, the 50th percent, then we've managed to lock in some improvements into the funding level. So for instance, at this point, August 2019, we can see that under 100% equities, the central position was 85%, and under the trigger-based strategy, it's 91. So that is a benefit. However, the key purpose of this was to try and reduce some risk. And the reason that this trigger-based strategy doesn't necessarily reduce risk if we look at it in this way is because obviously we're taking away all of the potential for this upside, because if we do well with investment returns, then we're moving away from return-seeking equities to more liability matching index-linked gilts. However, we keep all of the downside because if investment returns do very badly, then it's very unlikely that we return to the 82, the 84% level, at which point we move to risk reduction purposes. However, there is a way in which we can show that trigger-based strategies based on funding levels can show a reduction in risk. We've talked about what happens at the extremities, but if we move to having a look through PFaroe at more central positions of expected returns, then we can see how risk can be reduced, a different way of looking at it. So at the moment, we're looking between the 5th and the 95th percentiles in terms of stochastic returns. What I want to do now is to have a look at the 25th through to the 75th on both scenarios. So I'll click off the more extreme values here. And you can see if I do this, we can see a very different story. What we're seeing with the dotted red lines, this is the 25th through to the 75th percentile scenarios on a stochastic basis for the 100% equities strategy. And then the blue lines are showing the 25th through to the 75th scenarios on this trigger-based strategy where we move towards index-linked gilts as we get closer to fully funded. And we can see that if we look in this range of scenarios that's more plausible, so ignoring the extreme ranges, then we are getting a significant reduction in risk, and we can see even more clearly the central position where the funding level is improving. So we're getting the two benefits of higher expected funding levels over time and the key purpose in the first place of a reduction in risk. So I think the key message to take away from here is that these results clearly show that if there are extreme results with investment returns, then trigger-based strategies won't necessarily show the benefits that were hoped for in the first place. However, if there are more likely scenarios to be played out through the investment returns over time, then there's a good chance that a trigger-based funding level strategy could significantly reduce your risk and hopefully increase your funding levels over time as well. Clearly, this is just one simple example. However, we would expect this type of outcome to be shown for all different types of schemes.